Thank you, Sylvia, and good morning to everyone. Well, yes, our best quarter ever. It's a broad beat across all the KPIs that we follow, and it widens the gap to our peer group. Fundamentally, we were able to compensate the planned decline of NII with much increased fees, further boosted by client trading, which got our revenues to be much higher than we expected in the quarter. We continue to have a firm grip on cost. On same perimeter, we're down 1.3%. Our cost of risk is still mild at 8 basis points, which is quite low for banks. And that, together with a very efficient use of capital, allowed us to deliver a 22% return on tangible for the quarter and increase profit by 8%. Most importantly, all of that leads us to increase our excess capital from 6.5 billion to 10, and then haircut it on what we think we can distribute, which goes down to 7.5, but still 1 billion more than before. All of this together allows us to be quite confident in increasing our guidance to an increase over last year in both return on tangible and net profit, with potential further upside. Our distribution will go hand in hand. So I think this is what gives us now a lot of confidence that we can reach our target of 10 billion at high teens return on tangible by 27 and distribute in each and every year more than the 9 billion we distributed in 24. Actually, that number is increasing now.
So I want to look at the strategy going forward, Andrea, thinking about how you managed to overcome the drop in net interest income. I'm wondering whether that strategy will continue to be applied going forward, given the expectation that we might see lower rates for longer.
Well, look, we said at the beginning of the year that we were going to be hit by a reduction of net interest income. Some people were more positive than we were, but if you look, we are the last bank reporting, our trend in net interest income is actually one of the better one in the sector, so we were correct in our expectation. We think second quarter, third quarter, fourth quarter are going to be below the similar number of last year, but because of the very strong first quarter and all of the buffers we have accumulated, I remind you, we have 1.7 billion in overlays and 1.3 billion in our buffers. We're confident we can beat next year. Now the question is by how much. But it is core revenues trending in the way I described and compensated by all of the buffers we put aside in the last few years for exactly this moment. From 26 onward, the operating performance will be going up year on year.
I also would like to look at the Italian economy for a moment. Thinking about the GDP for the first quarter, it came in at 0.1%. But what are customers saying at this stage, and what are you seeing on the loan front that indicates the health or perhaps the concerns really of the Italian economy?
Look, I think we're in 13 economies. We're in Italy, we're in Germany, we're in Austria, we're across the CEE. I think while the growth rates are not the same, the concerns are the same. We have uncertainty, we have volatility. That is never conducive to increasing investments or increasing spend. That said, banks have performed quite well in this environment in the last 3-4 years. It was primarily due to a tailwind from rates. In our case, we added alpha from our transformation. In the next few years, we will have a headwinds from rates and from this uncertainty, but we think that our transformation will be able to overcome that and allow us to grow from there. But in general, individuals, families, companies do not like an environment where there is uncertainty and volatility. I would only add that all governments in Europe are set to increase their spend to support defense, to support transformation, to support innovation, and this will be a net positive. And if we get to some sort of ceasefire or peace with Russia, then that will be another net positive.